What's up, investors? This is the new layout. Switch the camera position a little bit. Also, I fixed my computer. I'm very happy about that, but not without casualties. 100% of the data and information that I had on this computer is gone. I had to reinstall Windows from a USB drive because there was just no way I could restart the computer. For those of you wondering, I believe it was a RAM issue and I could not get the computer to work. So after making sure that everything's in place and everything's cleaned up, I had to resort to this. But anyways, I'm back now. I don't know what this looks like. I'm gonna have to see how the video comes out after this. I've tried to actually increase the settings and try to make the picture and sound even better than it was before, but it could be worse. So I would appreciate some feedback on that. Once I upload the video, I'm gonna try to see how much I succeeded or failed in that attempt, because video quality is huge, you know what I mean? All right, but moving on. I haven't made an update in quite some time. The last ones I made were from the phone and they were really crappy. So basically, I've just mentioned what I was doing. Now, when it comes to that, the latest updates for the trades are that calendar spreads are closed, and I had one winning one and one losing one last week, which basically canceled each other out. I did sell a few calls on the Apple shares, which ended up expiring worthless. So I collected maybe like $50 or $70 off of that. I also closed out a put that I sold against Main Street Capital, and I gained about $15 to $20 net over that during the week. So it's been a muted week. I'm trying not to take too much risk right now. I'm trying to stay with some cash because I want to be able to take advantage of any opportunities that arise in the coming weeks, with potential problems being caused in the banking sector and in the rest of the economy due to ever increasing interest rates and other reasons like contagion, doubt, in the system, etc. So I'm looking actually forward to buying either Apple shares cheaper or Main Street Capital or Realty Income cheaper than I have right now. And I've already bought a few shares actually. If you're interested to see, oh, look at this transition. You guys like this? Boom. Fade, fade. Oof. Good? No good? Standard? I don't know. So I've actually bought some shares of Realty Income, Main Street Capital, and I still have those KRE shares. I'm looking to exit. I don't want to have this trade on the books anymore. Okay, right now I'm down $89. I wish if I was even, I would probably exit. I just don't want to wait. I'm sure that the regional banks are going to prosper and do better in the future. I suspect that that's only going to happen after a further down move and the end of the increasing rate cycle. I don't think we're at the end of the increasing rate cycle because just recently the Fed raised another quarter of percentage points. But so I think we're actually kind of far away from it. I don't know how far, but they won't start performing until that reverses, I think, because they've proven that they're the most sensitive when it comes to interest rates, the regional banks, that is, and carry index is the regional banks. Now, there are some individual banks that have performed quite a bit. Like, for example, let's take a look at First Citizen. Check this out. First... What? Hold on one sec. Sorry, we're encountering an error. How can you be encountering an error? First Citizen. There you go. What error are they encountering? So First Citizen Bank is actually at an all-time high. At least in the last 5 years. It has not been over $900. Oh, it has. So basically at an all-time high. It's like $20 off. After being, at 509, it's now at 891. Look at this 1 week chart. Isn't this crazy? So I guess the motto here is buy buy a bank that's in trouble and default and canceled by is it FDIC or the SEC, or I forget who makes the decisions. But one of those, 3 or 4 letter agencies decided that the bank has to go. So they took the bank under, and now the assets are for sale. First Citizen Bank bought them, and now they've basically inherited this huge deposit base, which effectively doubles the value of the bank. I mean, I had the same thought. I'm like, oh, First Citizen is buying Silicon Valley. That's the largest, literally the largest bank Silicon Valley was, the regional bank in the entire U.S. So I'm thinking, okay, I should buy First Citizen, and they go in there, and it's like already 50% up. Ridiculous. So everybody had the same idea. Had I bought in the beginning of the day, I would have actually made some money because it kept on drifting upwards throughout the day. It may even still go up, but that's not going to last forever. Of course, it's just a short-term trade. It could stay up there, depending how the details of the acquisition pan out, but we'll see. So First Citizen, huge move right here. Yeah, I think it climbed another like 10% throughout the course of the day, so it would have been a winner. All right. Furthermore, what are we talking about here? Main Street Capital. I picked up some shares from Main Street Capital. I now have $40,000 worth. Now, these are doing an intermittent dividend, so that means they're making quite a bit of money. I don't know why they're making so much money right now. It's probably temporary. I'm thinking the higher interest rates will actually, I guess it does make sense, especially if they have adjustable rates of some sort, but the way I understand it is they lend money out to businesses and then they just collect the spread, and they have a really healthy dividend of 6.8% or something like that. Let me say, yeah, 6.63 right now. So a dividend of 6.63, and that's achieved by actually giving out dividend once a month, and then sometimes when they have some extra cash, they just spit it out in a dividend form, just like this. So I'm getting an extra $175 here for last year's probably gains. I'm not sure if it's this past quarter or last year, but whenever they have extra cash, they spit it out, which is great. I love it. So I have $40,000 in it. It's great. Now, these kind of funds are pretty tricky. So if you do decide to go into realty income like I did in Main Street Capital and some of these other funds, I think you have to be careful because it's not like they're not a for sure thing. Even though they have been paying out for like 20, 30 years straight with increasing dividends each year, it's very possible that one year, something they hit a roadblock and they just cut the dividend in half out of nowhere. And now this investor and the value of your holdings, it's possible that they get halved. I mean, it's not out of the realm of possibilities. Because the way these funds work is they issue shares to make new purchases, and then they set they get new properties, and then they hire tenant, and they get tenants in those properties, which pay them a monthly fee, which then they use to fund the loans that they made in order to make the acquisition, right? Or or they basically spit out those fees to the investor sometimes, depending. They just basically massage it so it's the most tax optimally used cash. So they massage the figures quite a bit, but my point is that it's a pretty leveraged game. It's a real leveraged game, and it's reliant on constant deal making, constant good conditions, and really, really good management. So as long as that's in place, then no problem. It can go another 30, 40, 50 years, no problem. But if the conditions change, and one of the things I mentioned changed, like the management, for example, it's very, very possible that these funds get halved or worse. So you have to know these risks going into it ahead of time and be willing to take it in the chin if something goes wrong. It does happen to other funds regularly. Now, these two so far have been really well ran, so no issues there. But we don't know what's brewing underneath. There could be some large problems happening, especially now with the rising interest rates, where either the deals are not as good or whatever, or people start defaulting more because of economic conditions and what have you, and things may turn for the worse, even for stable funds like these. Okay, so that's Main Street Capital. Let me show you how much their regular dividend is. Okay, we'll go into under the history, and this tab is completely irrelevant here. Don't even look at this. It doesn't have anything to do. Yes, they record some kind of earnings, some kind of number, but this is really relevant. So don't look at that. Let's go into the history so I can show you recent activity. So this is the little extra dividend they're paying me, but the regular dividend per month, this is me just buying back the put, and then I bought some shares, 10 shares here, 5 shares here, 9 shares here, etc. And this is the dividend reinvested of 220.76. So 40 grand will basically get you, a little bit more than this now. So probably 230. So 40 grand will get you $230 per month in a dividend. So, if let's make this a little relatable. So let's say if I put the entire account in Main Street Capital, that would roughly yield me almost $1,000, like $950 or so, just a little napkin on top of my dome math. So $950, that's not bad. That could pay some bills, right? That could pay your rent if you're renting a room somewhere in the Midwest or something. Definitely not in Silicon Valley, not in California. I mean, I'm not there anymore. I'm in Southern California now, but still. Definitely not going to pay you rent anywhere in California, probably. But you could probably, you could live okay somewhere in a really cheap country at $950 a month. Now, the other fund, but that's what the regular dividend looks like, right? Look, it was 219 before, right? And then increased to 220 because the dividend was reinvested. So, but increased by about $1.20. So each month, this dividend will increase by $1.20 if I keep reinvesting it, which I plan on reinvesting for some time. We'll see if that holds up. Some of the pricing for these shares that I've added here, you can see 38.89, 38.63, 38.26. Okay, and right now, it's sitting at 39.38. So I bought somewhere around in this area here. Okay, so I'm actually profiting from I have some unrealized gains from my recent purchases of this fund, but I don't plan on selling them. Now, I'm actually waiting for this fund to come back down a little bit in order to buy even more. I want to convert some of this KRE garbage into Main Street Capital. I might sell this at a loss because I really don't want to hit. I would actually rather put it in cash because Robinhood Gold, ladies and gents, Robinhood Gold, where is the tab here? Right here. Look at this. It probably says it somewhere. But the rate right here, currently you can earn up to 4.4 APY. 4.4 annual percentage yield. That's what APY stands for. So that is, I just discussed how beautiful and powerful Main Street Capital's dividend of 6.63 is. That's not that far from 4.4. You could get 4.4 with zero risk. Zero. You can just be leaving it in your Robinhood account. Earning interest. This is actually very high. I don't think any other brokerage offers as much as 4.4. I know Wealthfront does like 3.35 or 4.35 or 4.3 right now. And I'm sure other brokerage houses do a good job, but I think this is the highest one. Somebody correct me if I'm wrong, but from what I've seen. So anyways, you can get 4.4% yearly, which is, instead of $950, you'd be getting something like, $700 or something like that without any risk at all. Of course, you're taking inflation risk. It's not, I've been showing my face this entire time. So this is what I meant. This is where it says the 4.4 APY. Correct me if I'm wrong. And Main Street Capital is 6.63. So you could be taking in like $700 or so risk-free cash. The only risk you'd have to actually pay is inflation risk. Okay, you would have to factor in inflation rate, which currently is probably running hotter than that, but I haven't actually seen the latest figures. Plus, we don't know what's going to be in the future. But that rate is subject to change. It's not, you can't like lock it in. You can lock it in if you buy like CDs, certificate deposits, or you can lock it in if you buy 1-2 year treasuries. In fact, you can probably do that on Robinhood. So if we go, let's search up 2 year, see what comes up. 2 year. No, this is 20 year. How about short-term treasuries? Short-term treasuries, SPTS. I wonder what the duration is on that. Okay. It looks like it's just recently spiked a little bit in value. So we can find out probably here. Cash and cash equivalents, government bonds. Assets, okay, tells you. I don't see the breakdown. I see United States Treasury notes and then the percentage yield. But I don't actually see which durations they're owning. Oh, okay, right here. Index traded 1 to 3 years of treasuries. 1 to 3 year US treasuries. Number of holders 97. So they hold 97 different contracts here. 97 different bonds. The 30-day yield is 4.44. So a little bit higher than Robinhood is offering on its cash at the moment. And the expense ratio is 0.06. So actually, it's a little bit less. It's by 2 basis points less. So 4.42 is what you can earn on this. So if you want to lock in the Robinhood 4.4 roughly, 4.38 is what this is going to give you if you subtract out the expense ratio. So if you want to lock this in, then we know what I should actually do. This is giving me an idea. Instead of keeping it in the cash, I can buy this because I get the margin for free on the extra $1,000 of cash, right? So Robinhood offers, I just got this idea right now. So $1,000 margin free, right? Interest free. So if I actually add this $1,000 into this fund, I'd be collecting 4.4 roughly percentage interest on this one extra $1,000 plus all the other money. So I can lock in this interest and an extra $1,000, so an extra $44 per year. If I buy this, this is actually not a bad idea. I'm gonna look into this if I want to go really passive on most of these funds. Maybe I'll leave like $200-300 to just play options with for now, and while I wait. Not bad, good idea, guys. Thanks. This is great. This works. Okay, so let me see. What was that fund again? SPDR, short-term treasuries, SPTS. Let's see the volatility here. It looks like it was pretty stable in 2020s. And then, of course, it crashed with some of the long-term bonds. And then it had a spike up recently after the relief rally from the so-called regional bank crisis here. The price didn't change that much. I think this is worth buying if you want to lock in some yield. Okay, not bad. Let's take a look at some of these metrics here. I'm gonna have to do some more research, but AUM stands for assets under management. For those of you who didn't know, So the assets under management is 5.82 billion. It looks like it's not that volatile. It doesn't move that much, and it shouldn't. It's the shorter the duration of a bond slash treasury bill note, whatever. The shorter the duration, the less volatile it's going to be, because it's closer and closer to expiration, where the yield of the instrument will be known. So that's a good rule for you guys to remember, is that, the longer the duration, the more volatile the asset. It's kind of counterintuitive, but the 30-year is actually the most volatile one. It travels up and down quite a bit based on, inflation figures, etc. The yield, whipsaws the price, the value of these bonds by a large margin. In fact, that is the sole reason why this bank crisis happened to begin with, is because all the regional banks were loaded up on 30-year treasuries, right? 30-year bonds, and then the price action of them, they dropped in value so much that now liquidating them and covering deposits became a problem. So it's a good rule to remember here for bonds. Let's see. It gives me some figures here at the bottom, month to end, quarter end. That's interesting. Okay, it shows returns. They're required to show the returns for different time periods, kind of like retirement funds. Interesting. Very nice. Okay, so I got an idea. SBTS. But I mean, this is ultra conservative though, right? Like, putting my money in this fund is like really conservative. It's just akin to buying putting in a CD or something like that, and which you can exit anytime if you feel like it. If it goes up in value substantially or whatever, you could just exit it. Or if it goes down in value, you can just collect the yield. However, I will say that they keep turnover, right? They turn over the assets, and so it starts to match more and more the current price action of the bonds. So, it's not as surefire. It's not as good as a CD to lock it in, is what I'm trying to say. But it's something to look at if someone's interested in collecting some yield. What else? The options, they're the same. Nothing happening really. These Babel ones are irrelevant. The PayPal ones it's pure leaps right now. They're expiring next January 19th of January 2024. And they're suffering some heavy losses as of now. This is just kind of a YOLO play, really. But you can see how much value it's dropped over the years here. I have personally lost 95% on this option, or $3,000. I logged in quite a bit of losses from this, trying to catch the knife on the tech bubble bursting. So anyways, $2,000 down. I'm sorry, $3,000 down on this. It currently still has value. It's 142 per contract, and I think I have 2 of them, so I could technically sell them and get back $300, but I feel like just keeping the option open just in case there's some kind of weird like PayPal tech boom again. It's probably worth $300 to keep in there to have a chance to recoup my money or even make some profits. So I'm probably gonna keep them, and that's it. Those are all my positions. This is my investing account here. Brokerage cash, blah blah. Looking to get rid of KRE, $89 in the negative. Realty income is actually pretty flat right now when it comes to P&L, but they've spat out so many dividends along the way. And right now, under 60, actually, I'm a huge buyer of realty income. I want realty income to drop even more so I can buy even more shares, because I think they're even more stable than Main Street Capital. I've currently only $30,000 in there, and the dividend is less. So their dividend is 4.86, which is very close to the yield you would get from just sitting in cash in a brokerage account. So that's something interesting. The market cap is 40 billion in this company, so it's quite large, and it keeps growing. So that's about it. Oh man, I need to get better at switching from browser to Facecam. Apologize for that. I will get better. This is Realty Income 5-year chart. And I started talking about the PayPal option. You can see the 1-year chart here. This is the 5-year, the 1-year chart. Lost a lot of money, down $3,000 or 95%, keeping it. And then lastly, I showed you the account, which is this. You can see Realty Income is about flat. Main Street Capital up $2,000. Apple is back into profit, 12,606. And then KRE, which I'm looking to exit, down $89. You can see the breakdown in size visually here. KRE is just a small portion of the account at the moment. And then this is stocks and options and cash of $3,209. All right, please comment on the don't comment on my crappy camera work. Okay, I already know, but how do you like this view, this angle? I kind of like it like this, a little straight, and then also the video and audio quality, okay, of this clip. Like, I would appreciate that. I'll also be looking at it myself once it's uploaded. Hopefully you guys are doing all right. As you can see, I'm currently just in passive mode. I'm just buying time by playing little calendar spreads and selling call options and put options in small sizes. So let me know how you guys are doing and what you're looking for and whether or not you're waiting for something like me. But I'm just curious and interested to hear about. Peace out.